I've recently been seen talk about bond tents to protect against sequence of return risk right before and after retirement. I'm having a little trouble getting my head around bond tents and even sequence of returns risk. It seems simple, but maybe it's not. I was wondering if you'd be up for a blog post about it. Bond tents come up on fire sites quite a bit. As an EM doc who started med school at 30, I'm not in the fire crowd, but would like to retire in about 10 years. So I'm starting to think about that phase of my savings. Well, shoot, if you're thinking about retiring in 10 years, you're probably a fire kind of person. Just because you don't retire at 32 doesn't mean you're not a fire person. I mean, early retirement, 62 used to be considered early retirement. So if you're still talking about retiring in your 40s, 50s, or early 60s, I think the principles of fire certainly still apply to you, even if you're not the classic tech bro that retired at 28, right? All right, sequence of returns risk is the risk of running out of money in retirement despite having average returns that were adequate to sustain your withdrawal rate because the crummy returns showed up first and the good returns showed up later. So what you're trying to avoid is the combination of withdrawals and bad returns early on, because that can cause you to run out of money. That's what sequence of returns risk is. So what is a bond tent? Well, the idea behind the bond tent is that your percentage of bonds goes up as you approach retirement and as you're in your first few years of retirement, and then goes back down. And that came from these research papers that came out in the last few years that suggested actually increasing your percentage of equity in retirement can reduce the risk of running out of money in retirement, because the big risk there is inflation, right? Inflation destroying your savings. If you get all your money in bonds, there's not much fluctuation there, not much volatility, but it's at risk to inflation. And so that research showed that if you actually increase the percentage of money in equities throughout retirement, that risk is lower. And that's true using past data. The problem with that is sequence of returns risk, that period of time right around when you retire. And your biggest risk year is the year after you retire. And then the year after that, and the year after that, and the year after that. And then you go back to the year before you retire and the year before that. But basically for 3 to 7 years after you retire and 2 to 3 years before you retire, that's your highest risk time for a big, nasty bear market affecting your retirement spending. And so the idea is that during that period of time, you have more bonds than you would otherwise have the rest of your life during the accumulation phase and even later during the decumulation phase. And so that's your bond tent, is maybe you were 65% stocks and 35% bonds, and you went to 50-50 for that period of 5 to 10 years, and then you went back to maybe 60-40 or something like that. That's the idea behind a bond tent. I hope that's helpful. It's no more complicated than that, but that's the idea behind it. Now, there's still lots of people out there that think you ought to just gradually decrease the aggressiveness of your asset allocation throughout retirement. So this is definitely a controversial area. Maybe you ought to just decrease how risky your asset allocation is 2 or 3 years before you retire and keep right on decreasing that. That wouldn't be a bond tent. With a bond tent, the idea is that you later increase your equity allocation. Hope that makes sense. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA. or click the link in the description.
My dad, your host, Dr. Dahl, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.